Hello, and welcome to Cat Politics. So unless you've been living under a rock until very recently, you're probably aware that back on the 23rd of June, the UK voted to leave the European Union. At the time, Big Cat, who was in favour of Brexit, and Small Cat, who wanted to remain in the EU, gave their opinions on the possible impacts to the British economy and promised to revisit the situation in the future to see how things were going. So now we're 2 months on from the referendum result. How is the economy doing? Which of the cats will win the prize for being right about what would happen? However, before we can solve that debate, we have to ask, how do you measure the health of an economy? Some of the indicators most commonly used by economists are unemployment, interest rates, inflation for both consumers and producers, and the value of the stock exchange and UK government bonds. For each of these indicators, Big Cat and Small Cat will take a look at the latest figures and decide if things have got better or worse since the Brexit vote. The employment figures for the UK rose in the months prior to the vote. And in fact, the latest figures show that employment is currently 4.9%, the lowest it's been since 2005. Unfortunately, there's not much data on the period since then, but there are some indicators that the job market is set to contract, at least in the short term. Financial reports from several major recruitment firms and a recent survey by the Institute for Fiscal Studies suggest that businesses are being more cautious about hiring in the face of continued economic uncertainty. Until we have some concrete figures on the job market for that period from June onwards, it's difficult to say whether the recent trend of rising employment is going to continue or whether the forecast for a fall in the number of job openings is going to come about. So at the moment, this economic indicator is a bit of a wash. No points for either cat. Mark Carney and the rest of the Bank of England's Monetary Policy Committee recently cut the base interest rate to 0.25% in an attempt to get the economy moving. They've also hinted that it may go as low as 0.1%, which suggests they're still very concerned about the long-term outlook for growth. Whilst low interest rates are good in the short term for businesses and consumer borrowers, they generally indicate a sluggish or stagnant economy in the medium term. Predictions for the future growth of the economy this year are quite varied, from 1.6% to minus 0.3%, depending on who you believe, but they all suggest a slower rate of growth as a result of the referendum than would otherwise have been the case. Lower interest rates are one of two mechanisms that the Bank of England can use to try and stimulate growth, the other being quantitative easing, but so far neither of them appears to have been having much impact, so this has to go down as a point for Small Cat. The most commonly quoted indicator of inflation, the rate at which the price of things is increasing, is the Consumer Prices Index, but so far this has been largely unaffected by Brexit, showing only a small increase which has mainly been caused by rising fuel costs. On the manufacturing side of things, though, there's recently been a huge surge in output as the weak value of the pound means that UK exports become cheaper, and this in turn has led to companies boosting their production to keep pace with demand. Having said that, manufacturing costs have risen sharply, in some cases by as much as 10%, as the weak pound also makes imported raw materials more expensive for producers. These increases haven't made it to the shops yet, but businesses will inevitably have to offset their rising costs one way or another. Unless they raise the prices of their goods, the only alternatives are to freeze wages or cut back on staffing. Either way, the outlook for inflation is distinctly negative, so this has to go down as another point for Small Cat. The value of the stock market has been steadily increasing since the vote, particularly when compared to the 6 months prior to it. It's probably not best to read too much into this, though, as it's mainly because investors have been moving their money into stocks and shares and away from less favourable markets like currency. Another good example of a struggling market is the buying and selling of UK government debt, known as bonds. The return on investment, called the yield, for all types of UK bond products have dropped sharply in the last 2 months, which ironically pushes their prices up, so that you are paying more in order to earn less. One positive side effect of falling yields is that the cost of borrowing for the UK government has become extremely low, which is good news if the Chancellor of the Exchequer decides to spend some money in order to get the economy going. Another plus is that overseas investment in the UK, with the exception of the property market, remains good. So all in all, this looks like a point for Big Cat. What about the value of the pound, the cats here, you ask? Well, the cats have already discussed the major consequences of the low value of sterling as part of the other measures, so it doesn't really need its own category, so no points for either cat on that one. Where does all this leave us? Small Cat has 2 points to Big Cat's 1, so it looks as though, at the moment at least, the vote to leave the EU has had a negative impact on the economy, but that it hasn't been anywhere near as bad as many people predicted. It's also worth remembering that Brexit hasn't happened yet, and won't happen until 2019 at the earliest, so at the moment we're only seeing the impact of the decision and not the reality of life outside the EU. The cats will no doubt come back to this issue again in the future, but for now, thanks for watching and don't forget to like and subscribe.